We're going to have a quasi-virtual fireside chat today. I'm mostly going to be interviewing Matt, asking him some questions on a little look back of what happened in 2022, certainly a volatile year in the markets, have a discussion around that. We can never predict the future or have the crystal ball here, but we can give some opinions on what we think is happening around not only the United States, but around the globe, and what that means for many people planning for retirement or who may already be in retirement. So we'll have some discussions. I want to pick Matt's brain. And then we'll flip the script. Matt will ask a couple of financial planning topics, questions, and I'll try to give my best answer on those. I think we'll be out of here in 15, 20, 25 minutes tops. And we are going to be monitoring the chat for questions as they come in, as they usually do. And without further ado, why don't we hop into this, Matt? Sound good?
Sounds great.
All right. So I guess my first question, and we got a lot of questions from clients, and we're talking a lot about this, is really kind of what happened in 2022. Kind of a loaded question, and I know you wanted me to share my screen, which I'll do right now. And Matt, if you could talk us through a little bit about what happened last year, we'd appreciate it.
Yeah, absolutely. As we all know by now, there was not a lot of good news in the markets last year from a return perspective. And this is our one visual aid for today that Ross just threw up. And some of you who are our clients on the 401k side are very familiar with this layout. But essentially what we're looking at here in the bottom left are a lot of the major market averages that everybody's familiar with, whether it's the Dow Jones or the S&P 500 or the NASDAQ. And it's sorted by that first column, YTD, or year to date. So this is the calendar year performance for 2022. And as you can see, aside from that top listing, the commodity index, which posted a nice positive return, everything else, be it both equities and fixed income, declined last year. And I'll give a few brief reasons why for that. But clearly the commodity index did well based on a lot of the geopolitical stuff going on, and certainly the energy issues with oil, but even commodities themselves really started to come down in price once we got through the spike in mid-year. But as we're going down the page here, just a couple of thoughts for you. The Dow Jones was only down a little under 7%, 6.86, which is basically due to the fact that the Dow Jones, number one, it's a smaller index with only 30 companies, but it has companies that are larger cap in nature and more value-oriented, lower valuation type companies. So they held up. They didn't produce a positive return, but they held up much better than the high growth, high tech index, which is the NASDAQ, which is at the bottom of the page, a negative 33% return for the NASDAQ. NASDAQ is home, of course, to the Microsofts and Amazons and Googles of the world. And that tech sector really was the area of the market that suffered the most last year. So a real dichotomy between kind of old economy value-oriented stocks, which held up reasonably well, still negative, versus the high growth, high tech space of the NASDAQ. And you can see how the indexes in between did. The S&P 500 was down a little over 18%. And then that third line item down, to me, was the biggest story of last year. This is the Bloomberg US Aggregate Bond Index. So for a bond index to be down double digits, 13% basically in calendar 22, that was really the biggest story. And so clearly it was very few places for an investor to hide last year. So outside of commodities, some select energy plays, or very short-term fixed income, money markets, cash, really no place to avoid negative returns. And for most of us that have diversified portfolios with various amounts of equities and fixed income, it was a really tough year. And just to give you, a further perspective on how historically bad, unfortunately, it was in 2022, if we go back to 1977, there were 8 separate years, 8 calendar years going back to 77, where the S&P 500 had a negative return. And I think as equity investors, we've all become conditioned to the fact that, hey, bear markets happen, drawdowns happen, stocks can be volatile on both the up and down sides. What's unique, though, about those 8 calendar years is the bond index actually produced a positive return in each of those 8 negative years for the S&P. Now, some of those years, the positive returns for fixed income wasn't that great, but the point is it was positive. It did represent a cushion in your portfolio. Last year was unique in that both bonds and stocks fell in tandem. So the S&P 500 fell over 10% last year, as we can see here, 18% really. And the 10-year Treasury, a key benchmark in the bond market, was also down over 10% last year. That's only happened 4 times going back to the 1930s. So it was a really rare occurrence last year where you had, again, that no protection from bonds in your portfolio, a historically bad year for that classic 60-40 portfolio. And so it was a situation where, again, nowhere to run, nowhere to hide outside of cash. So why did the bond market have such a poor year last year? I think is a very reasonable question. And it really comes down to a couple of factors. Number one, as we've all been very accustomed to in the news over the last 12 months, inflation finally broke out last year. And we had some seriously high year-over-year inflation numbers being reported by the government. I'm sure we've all seen the impact, whether at the grocery store, at the gas tank, and other areas of our lives. Prices are up across the board. In response to that, the Federal Reserve has hiked interest rates 7 different times in 2022. They took their target rate of the Fed funds from 0.5% all the way up to 4.5% by year end. And they really got started in March. So we had a really strong rise in interest rates driven by the Fed over a 9-month period, which again, we've seen rising interest rates in the past. It's been a while. But we haven't seen that magnitude and duration of the rate hikes. And that's what really spooked the bond market and obviously caused ripples throughout the equity market. So really, to sum up last year, it was the rising interest rate environment due to inflation, due to the Fed taking action, which really sent shockwaves through the market. And then the final thing I guess I would say on this exhibit, in the top section of the report, we're looking at a lot of the major mutual fund categories that you may have participation in, whether through your personal investments or your 401k plan. And again, these are different categories of investment in the mutual fund world. It's sorted by that first year-to-date column. And if we start at the bottom, you're going to notice one word coming up repeatedly: growth. And so growth managers, strategies that tend to invest heavily in technology, in biotech, in some of the, again, high growth areas of the economy. These are the strategies that suffered the most last year. And as you go up the page, again, we're not seeing any positive numbers, but certainly the negatives become much less of a magnitude. And this is where that diversification comes in. So if you had value strategies or certain flavors of fixed income in your portfolio, the negative returns were smaller, but again, negative nevertheless. So it was really a year within the equity world where if you had a bias toward larger companies or value-oriented companies, you tended to survive much better last year and have less of a negative return. And those investors that were in the most speculative, high-growth areas of the markets really got hurt the most. So unfortunately, that's what happened in 2022, Ross, and we're hoping for a better year in 2023.
So that's a kind of a leading question for my next one then, Matt. I mean, as a financial planner, we talked about all these things with clients, and if you're a plan participant in one of our retirement plans, ad nauseum last year. And I don't know if much of what happened last year has really changed or gotten that much better. So in your opinion, what are some of the headwinds we're all going to face in 2023? I know you don't have the crystal ball, but I'm curious what some of your thoughts are.
Sure. And again, I think in no particular order, just, what comes to mind is number one, the Fed is still going to be active this year. They are expecting, or the market expects the Fed to raise rates probably 2 to 3 more times, probably at 25 basis points per meeting. And the hope is that they're kind of finished with raising interest rates by mid-year. It could be sooner than that, but the expectation is that the Fed will keep raising rates. And the good news is that, again, that is the expectation. That's what people are expecting and understand to be happening. So it won't come as a shock like it might have a year ago when the Fed was super aggressive, much more so than many people thought. So those rate hikes are on the way. That should be a headwind, but again, it's expected. Couple other things. I think if you look in the news lately, we've started to see some fairly significant layoff announcements from the likes of an Amazon, a Microsoft, multi-thousands of people being laid off. And so we expect the unemployment picture to get worse this year, and potentially that could lead into recession. Obviously, it's a wait and see, but higher unemployment leads to less consumer spending, will have ripple effects in the economy. And so people have been, again, over the last year talking about, is a recession on the way? And there's certainly enough signposts out there to suggest we may be heading into a recession. It doesn't mean it's going to be deep and long and protracted, but from a technical perspective, could we have some negative growth in the economy? Very possibly. And that is not everybody's base case. So that will certainly be a headwind for the market. You always have the geopolitical issues, as we're well aware, in terms of the Ukraine-Russia war is still going on, even though it seems like it's fallen off the front page, but it's an ongoing event that has ripple effects. And then the final thing I think is that, getting back to equities, corporate earnings expectations are still pretty high, and we'll see. Now we're in earnings season. Companies are coming out and giving us their outlooks for the year, but a lot of people are feeling like earnings expectations have to come down, which hurts valuations, and typically stock prices do follow earnings. So if the earnings come down, it's hard to say that the stocks are at a great bargain price today. And so we do expect some more turbulence in the equity market for sure.
So we get a lot of questions from retirees, and one of the most probably popular types of allocations for somebody who's maybe retired or near retirement is that 60-40 portfolio, 60% equities, 40% fixed income. So if you're retired or you have some bonds in your portfolio, it's diversified and interest rates go up or stay where they're at right now, how do you think interest rates will impact investors' accounts this year?
Right. So as I said, rates went up last year dramatically. They've reset. They're likely to potentially go up a little bit more. The good news for that is for the savers, or for the people who have cash that is available for investment today. There are a lot of very conservative ways to generate a 4% or better yield on your cash today, whether that be through money markets, T-bills, very short duration bond strategies. So, the bad news is that rising rate environment really hurt returns last year. But again, for that marginal new dollar coming in this year, you're able to put it to work at a much better interest rate. So it's definitely beneficial for savers. I think it's going to be a better environment, in our opinion, for just fixed income in general, that we kind of feel like we're past the bulk of the storm, and that while the Fed is likely to raise rates a couple more times, it's expected to be modest, and people are looking for it now, where it won't be that big surprise. So we're pretty sanguine on fixed income today in terms of being able to generate a decent return in 2023. Again, and this is for higher quality fixed income, not the speculative, high yield bond market. And that's a different animal, of course. But for people who just don't want to go out very far on the risk curve, we think the opportunities are much better today than they were 12 months ago. And then back to equities, I think it's, again, wait and see. It's important to point out, when the Fed raises rates, it takes a while for that impact to be felt into the economy. Because, at first, companies are often able to pass along those higher costs through to consumers. Eventually, they reach a point where you can't pass along higher costs anymore without losing the consumer, right? And so eventually, I think, and with a lag, those higher rates start to feed into company earnings, which again affects stock prices. So it's an ongoing process, and we've seen it took a while for mortgage rates to go up, but when they went up really fast, right? So the markets react much faster than other parts of the economy. And so this is the year where the true impact of those 7 rate hikes last year is going to be felt across the board, and clearly different for different situations, different markets, but a strong impact nonetheless.
I'm always trying to be the optimist in situations where, things aren't great or portfolios are down. One of the nice things about interest rates going up, in addition to some of the things you said, is cash actually makes some money. When you factor in inflation, your real rate of return might not be positive, but there are some individuals now that can get 3 or 4% on cash if you're just a saver, like you talked about. But unfortunately, with inflation, almost half of Americans stopped saving for retirement in 2022, and a third had to tap into their retirement savings to, pay for expenses because the cost of goods were going up and up and up last year. So, 2023 inflation, do we see it going up as high as what happened last year? Stabilizing a little bit? Could it go down? And how will that impact markets?
A lot of people start by looking at the consumer price index, CPI, that the government publishes once a month. The market is, the equity market and the bond market for that matter, it is ultra fixated on that report each month. And over the last couple of months, we've seen the CPI index start to roll over. In other words, the year over year change has gotten progressively better. It's still high, much higher than it was a year ago, but compared to the all-time highs or the recent highs, it has come off the boil, if you will. We expect the CPI to continue to show improvement, and that will be, I think, greeted warmly by the markets. That being said, the Fed has long had this inflation target in mind of 2% inflation year over year that they try and manage to. It's not an easy job. We don't see inflation getting back down to that 2% target anytime soon. But compared to the latest CPI reading, somewhere I think in the 7% range, we could definitely see it going lower than that year over year. That should be a net positive. But I think it's important to point out with inflation, everybody has a different inflation basket, right? In terms of the goods and services we all consume. So my inflation basket with 3 teenagers in the house is different than yours, Ross, with a young child in the house, right? So, and that's just one example. We have different commutes for gas. We have different baskets of food we like to eat. So I think the real point of this is, though, inflation is going to remain an issue. It's going to be elevated. It's going to be woven into, our finances, unfortunately, before we get back to a point where we're looking at those Fed target numbers of 2% inflation a year. So, like I said, I think the good news is we're off the boil. It's moving in the right direction, but getting back to a pre-COVID level of inflation is probably not going to happen this year.
Yeah. Yeah. It's an interesting comment about the baskets. And when we do financial plans for a lot of different goals in somebody's financial future, different goods and goals can cost more. A travel expense can be trimmed, but maybe not your budget for your gas driving into work or buying diapers like I have to. I'm curious, we talked a lot about some of the negatives of kind of what happened and what's out there. For Sentinel, and just looking out at the global markets, what do you think are some areas that are poised well to potentially do well next year?
Right. So I'll repeat what I said a few minutes ago, where we're not as negative on fixed income, higher quality fixed income, as I think some people are. And it's justifiable after such a poor year last year that people would want to avoid bonds, avoid fixed income. But I think you have to remember, now that the rates have reset higher, that yield cushion you're able to get on your bond investments represents some protection. Even if rates continue to go up a little more, you now have some yield to backstop that. Whereas a year ago, when individual bonds and bond funds were yielding such a small amount, there was just no protection from higher interest rates. So we do think it's a better environment, especially if you're looking on the short, intermediate end of the bond market. So that's within fixed income. Within equities, again, we think, broadly speaking, if you're an index investor, we're still going to see some choppiness and some volatility. But in our strategy, as you know, Ross, we tend to not want to make big bets, right? We want to be really well diversified. That being said, we do tilt in certain directions where we feel more comfortable or there's a better opportunity. So within equities, we would still say having a tilt toward value makes a lot of sense. And so if you have value-oriented mutual funds in your 401k plan or in your private accounts, we'd expect those to continue to hold up well on a relative basis against growth. And then strategies that emphasize dividends, we think are still very attractive. And again, many of these are overlapping into that value space, which I talked about, but company dividends remain pretty solid, and they have the cash flow, at least the large caps do, to continue to pay out those nice dividends. So, playing it safe, looking for larger companies with stable dividends, I think is a good strategy in any market, but certainly with all the uncertainty of today's markets, it's an even better strategy.
Thanks, Matt. Always good insight. I know we got a few financial planning questions that came through that folks wanted to answer, or there were some comments too. So I think you have them on your end.
Yeah, a few did come in, and the first one was a pretty good one, really. It really gets into, if you look over the last few years, Ross, obviously pre-COVID and then coming out of COVID, and we've had some geopolitical issues with wars and market volatility of last year. When you look at it kind of holistically over the last 3 years, has that really changed how you approach the financial process or financial planning process for your clients?
So I don't think the process has changed. It's such a good question, but I mentioned a stat. Last year, half of Americans stopped saving for retirement, and a third tapped into their retirement accounts to keep pace with rising costs. So the financial planning process hasn't changed that much, but I think everybody's financial plan has to be recalibrated a little bit based off of what's happening out there with things you can't control. Some of the things you can control is your budget, your spending, being diversified, having different sources of money as you enter in retirement, or consider where you're pulling money from if you are retired. So our financial planning process really hasn't changed that much, even when you look at wars, rising inflation, interest rates, but you have to adapt to those changes. The portfolio needs to be readjusted. Oftentimes, it's actually one of the best times to go through a financial plan when you're in a bear market and your portfolios might be negative for a year. Because if you have a financial plan, and only about 1/4 of Americans actually do, 75% of Americans don't have a financial plan. If you have a financial plan and the plan still works when we're in a market like this, you can sleep well at night knowing that you're doing everything that you control in your financial house, because you can't control everything that's going on outside. So I would say one just kind of parting piece of opinion here is get a financial plan done and maybe do a financial checkup. That's probably highly encouraged at this point.
Okay. And I mean, the other question that we got in was maybe similar, but I guess it would fall under the actionable ideas category in terms of, here in 2023, what are 2 or 3 things that people can do to be more financially fit and more, ready in 2023?
I think number one is just get organized. So one of the things that we try to help clients do at Sentinel is make life easier. And a couple of things come to mind with getting organized. Take a look at your beneficiaries on your retirement accounts. Do those need to be updated? Do you know where your estate plan is? Many Americans don't have an estate plan, the will, the power of attorney, the healthcare proxies. Do you know where that stuff is, and do your loved ones know where it is? Maybe take a look at different insurance policies. Do we know where everything is? Would a surviving spouse or partner know how to handle all the finance or be able to access all the finances if something bad happened? So just getting organized is something that I think will make life easier, and it helps when and if bad situations arise, that loved ones can then continue on and life isn't too displaced. Other things are just increase your savings if you're able to. If you're fortunate enough to be able to have a retirement plan, if you're still working, the limits went up. So you can save more into your retirement plans this year, which is one of the nice things about inflation, is that people can save a little bit more. So what does that do to your retirement plan? Look at your emergency fund. I think the start of COVID highlighted the fact and the importance of an emergency fund when people were either furloughed or or maybe they were let go from a position, or, you know, if we enter into a recession, having a higher emergency fund, if you're worried about your job security, is really important. So you can weather those storms if that were to happen. And then we talked a little bit about it, but as interest rates start to rise, there are different types of investment vehicles now that individuals can use as rates increase that can help your financial plan, whether it's exploring, you know, a high yield savings account or something like that, that can make your cash earn a little bit more than the nothing we've made for years and years and years, or different types of vehicles to put your investments and hard-earned dollars to work that maybe aren't as correlated to markets. So there's different things that come about in different markets like this that allow people to update their financial plans and move forward. So those are just a couple things. Get organized, look at your savings rates, and then explore different options. And the last thing, get a financial plan done. It's like getting, you know, everybody's supposed to go get a financial, or not a financial, a health checkup every year. The same goes for your finances. So we're happy to help anybody if they need that at Sentinel, because we do a lot of that stuff here. So I'll stop rambling, and I'm just looking through the chat here, and it looks like a lot of the things we talked about here today, Matt, we've covered, which is great. I see a bunch of thanks for covering that. Looks great. Hopefully 2023 is a better year in the markets.